biggest day of the month for financial markets today because it is the release of the US CPI Consumer Price Index number. Why is it so important? The Fed absolutely has to get inflation under control now because of the banking crisis. We know that a lot of banks are in trouble. They bought bonds around the all-time high, pretty stupid to me. And they've seen the price of bonds collapse, obviously, because interest rates have rocketed in the inflation fight. And don't forget, the interest rates are actually still below the rate of inflation. So it's not a very aggressive inflation fight. It's more of raise rates and pray that inflation drops back to where the Fed needs it. If they were really serious about fighting inflation, then they would have interest rates above the rate of inflation. But they know if they do that, things are already breaking. Residential home prices are dropping. We've got trouble with commercial property in the US. I'm sure you've been reading about that. So there's a lot of stress in the economy. And at the same time, unemployment is at record low levels. Employers added 236,000 jobs last week when we had the non-farm payroll number. The unemployment rate fell to 3.5%. Anyone who wants a job has got a job. They're well paid. The employees still have quite a lot of power as far as wages are concerned, which can push inflation up or at least keep inflation high. So the Fed really has a tough balancing act. Now, if CPI comes out higher than expected today, then it's going to be further problems for the Fed because they are going to be pressured to raise interest rates. According to Reuters, consumer price data on Wednesday is expected to show headline inflation rose by 0.2% in March, while core inflation rose 0.4%. Anything higher than that could cause some problems for the Fed and could cause stock markets to drop, gold to drop, bonds to drop. May push up the US dollar in anticipation of higher interest rates, but the dollar is difficult to read at the moment. Really does look like we're stuck in a range, and we'll have a look at that soon. This is the daily chart for gold going back to October. Shows us a nice, strong bull run, approximately 6 months old. But don't be fooled. Look what's happening recently. Up one day, big up day, but no follow through. Then we pull back, almost erasing all the gains. Then 2 strong up days, completely wiped out in the next 2 days. Then a strong day. The market can look really strong and then just pulls back immediately. Now we've had a good run up. We broke above the previous high. I really thought that was a strong buy signal. We pushed up to 2030 and then pulled back all the way down to 1981. That was a really good support level on the hourly chart. Now we've managed to recover all of those losses. This market is chopping backwards and forwards. Yes, we're pushing higher, but you could not have held a long position through that. If I draw my trend lines on here, I can say, yep, there's a bull flag pattern. So once we broke up above the bull flag, that should have been a buy signal. All we did was reverse back to the support level. So if you're a gold bull, there is hope now that having retested the upper trend line to the bull flag that we can take off. But obviously we do need to beat the $2,032 high. This really is very difficult to hold a long position. I've tried it and I've been stopped. And then I didn't get the chance to buy at the support level. It just didn't quite hit my level where I wanted to get in. So I'm finding it really tricky to trade gold. When you scrunch the chart up, you realize that gold's actually not really in much of a bull trend. We're holding below the all-time high. When I put trend lines on here, it's quite obvious. The gold is actually really only trading in a sideways range. So just be careful. If you're mega bullish gold, the chart doesn't really back it up at the moment. I'm just going to put another trend line there. The chart really is just indicating that we're in one big sideways trend. And of course, if we can't get through the 2065, 2070 area, the all-time high, then we could drop quite significantly in the days, weeks, and months ahead. We could literally just reverse, even come down to 1600. Gold is seen as an inflation hedge, but I don't believe it. If inflation does start to pick up again, gold will plunge as we look for further interest rate rises from the Fed. The moving averages are starting to turn higher. 50-day moving average is the black line. The blue line is the 100-day moving average. But the 500 and the 200-day moving averages are still pretty flat. So it does warn that we could be holding within this big multi-year sideways pattern. This goes back to the middle of 2020, the 3-year-old channel. It's pretty well established. However, now silver spent a long time in this downward sloping channel. It's a 2-year-old channel. As you can see, the moving averages got really tangled up here, indicating that we were establishing more of a sideways direction. They were quite useful in that indicator. But Silver's broken up. Now, we had our buy signal on the break above this trend line. If you were following me, hopefully you jumped into silver and you've been running a long position. And this is starting to work really well. In fact, we're hitting a new high for this breakout in silver. So I think I'd rather be long silver than gold. As we speak, we're even trying to push above the 61.8% fib, covering that whole downward move from early 2021. That value is $525.25. We're trading at 25.31. So silver's even pushing above that 61.8% fib. Really does look very positive for silver. We are overbought on the slow stochastic, but I wouldn't worry about that. We can stay overbought for a long time. Here's the bigger picture for oil. We've had that correction since February 2022. So it's about a year-long correction, but starting to show some more positive signs. We're still trapped in this triangle pattern here after we broke down, and then we've got this gap from the production cuts that happened a couple of weeks ago. But since then, oil really has just been stuck in a very, very tight range. Can't decide what to do. We're caught between the fibs on the downside around 79.50, 79.00, and the trend line, which goes back to the 1st of December. I think we'll probably break higher. So just watch for a break above $82. That should be quite bullish. If we break below 79, we could get down to the 77.00, 76.50 area, and that should be a good buying opportunity for US WTI crude. We've got the trend line, we've got the 100-day moving average, good buying opportunity if we do break down and close the gap. Okay, that's it for the commodities. I'm going to go and have a look at the Forex markets and post another video.